If you like what you see, if I can please request you to subscribe to my channel. So what is the Buffett Indicator? The Buffett Indicator, also known as the market cap to GDP ratio, is one of the most popular tools used to gauge whether a stock market is overvalued or undervalued. Named after legendary investor Warren Buffett, the indicator compares the total market capitalization of publicly traded companies in a country to its gross domestic product, or GDP. In simple terms, the ratio shows the relationship between the size of the stock market and the size of the economy. The formula is straightforward. Take the combined value of all publicly listed stocks and divide it by the nation's GDP. Historically, a ratio around 100% indicates that the market is fairly valued. Typically, a result that is greater than 100% is said to show that the market is overvalued, while the value of around 50%, which is near the historical average for the US market, is said to show undervaluation. If the valuation falls between 50 and 75%, the market can be said to be modestly undervalued. The market may be fairly valued if the ratio falls between 75 and 90, and modestly overvalued if it falls within the range of 90 to 115. So what are some of the advantages and disadvantages of the indicator? The Buffett Indicator is fairly easy to calculate and allows investors to quickly assess whether the overall market is overvalued or undervalued. It provides a perspective on broad market trends. Historically, it predicted major corrections, for example, the dot-com crash in 2000 and the global financial crash in 2008. On the flip side, the Buffett Indicator fails to account for interest rates, which can greatly influence valuations. High or low interest rates can distort the market cap to GDP, making the indicator less reliable under certain economic conditions. It also ignores market and sector-specific factors such as technology booms or change in financial sector composition, which can bias readings if certain sectors dominate the market cap. The GDP is in itself a backward-looking measure and may not reflect future economic performance or market conditions. So what are some final words? The Buffett Indicator is useful for spotting valuation extremes and long-term market trends, but its predictive power is limited by its inability to account for interest rates, global sales revenues, and structural changes in the market. For the best results, investors should use it alongside other financial metrics rather than relying on the Buffett Indicator exclusively. So my question for the day is, what is the enterprise value to EBITDA ratio and why is it so popular?